Okay, so the question reads: First Zambian Bank is one of the oldest and largest commercial banks listed on the Lusaka Securities Exchange. The banking sector in Zambia is with FZB holding a significant share in both the retail and corporate banking. On 1st March 2024, FZB released its audited financial results for the year ended 31st December 2023. The announcement was made before the market opened. The results showed a 25% increase in profit after tax, driven by higher net interest income and reduced loan loss provisions. The bank also announced a final dividend of 1 kwacha 20 ngwe per share, bringing the total dividend for the year to 2 kwacha per share, up from 1.6 in the previous year. The day before the announcement, 29th February, FZ, FZB's shares closed at 18 kwacha 15 ngwe. By the close of trading on 1st March, the share price had risen to 19 kwacha 8 ngwe. The Lusaka All Share Index remained relatively flat over these 2 days. So these are the extracts from uh, FZB's financial statements. Okay, we've got ratios here. You've got the return on equity, all right, earnings per share, dividend per share, price to earnings, and debt to equity ratios. So required questions. Number one, A. The share price reaction to FZB's results announcement provides evidence for testing the efficient market hypothesis. Which form of market efficiency, weak, semi-strong, or strong, is being tested by this event? Justify your answer. Okay, so colleagues, this efficient market hypothesis, basically what it's telling you is the share price reflects all the information that is available on the market. Okay. All information that you need in the market is reflected in the share price. Okay. So, for example, if a new company discovers presents a new product or discovers something new, people are interested in that. They will want to buy shares in that company, the share prices are going to rise. So that information, when the share price rises, is because of that new product the company has found, made, or that new discovery. So in simple terms, the efficient market hypothesis is just saying that all the information is reflected in the share price of the company. All the information that you need to know. No one can come and tell you something else. No. Okay. The market reacts to these new things. If there is a company is in a scandal, share prices are going to drop. All right, that is going to be that drop in the share price is because of that scandal. Okay, so there are three forms. The weak form basically just says the main thing about these forms is just what kind of information is found in the share price. Okay, colleagues, what kind of information is found in the share price? Okay, the weak form, basically, the information that's reflected there is past and historical data. Okay. Past or historical data. Okay. That is reflected in the share price. The semi-strong form, the information that's found in the share price is public information about the company. The public information about the company. Okay. Then the strong form, it's both public and private information. And private information that is found in the share price. In the share price. Okay, this private information is just known by a few. Okay, it's just known by the people within the company. Okay, no one else knows that information. Them, it's only them who are aware. So in this case, colleagues, here this event is showing the semi strong form. Okay, the semi strong form. Public information about the company is reflected on the share price. Remember, this company has just published its financial statements. Listen, they have shown that the profit after tax has increased, okay, by 25%. Okay, they're earning more interest income. Okay, I've seen driven this profit after taxes increase was because of higher net interest income, okay, and reduced loan provisions. Okay, so this information and also these financial statements, it's public information. Okay, so according to the semi-strong form, when a company releases its financial statements like this and gives out its reports, as investors or people who are investors are going to see, oh, this company is doing well. Okay, their profit after tax has increased. Okay, their return on equity has also increased. Earnings per share has increased. Dividend per share has also increased. Okay, the debt to equity ratio has dropped. Okay, so to an investor, this looks good. So the investor is going to want to buy shares in FZB. Okay, because remember, colleagues, what drives share prices up is demand for these shares. When people see a company is doing well, they want to buy these shares. Okay, so what will happen? The price of the shares is going to rise. And as we have seen in this case, the price of the share rose. Okay, the price of the share rose from where was this? From 18 kwacha 15 gwe to 19 kwacha 18 gwe. Okay, so this event here is the semi-strong form of the market efficient market hypothesis, which says the share price reflects public information about a company. FZB released its financial statements. Investors have seen that FZB is doing well, so investors want to invest in FZB. Demand for their shares has increased, thus, the share price increases. Any questions, colleagues? Okay, so I sent notes about this efficient market hypothesis. You see everything there. We can go to part two. Based on the information provided, does the price reaction support or contradict the semi-strong form of the efficient market hypothesis? Explain your reasoning. Okay, so yes, it supports that. Okay, it supports the semi-strong form of market efficiency. Okay, here's our justification. As we can see, share price increased by 7%. After this company releases its financial statements and it's shown investors that they are doing well, the share price has increased from 18 kwacha 15 gwe to 19 kwacha. So this, just by this is evidence alone to show this is the semi-strong form. Okay, and if let's say for example FZB releases their financial statements and all this information. And then you find the share price still stays the same, or maybe goes drops, right? Then they would have said, okay, the semi strong form is not in play. But right now, it's in play because we have seen the share price has increased. And this increment of the share price is supporting the semi strong form because FZB released its public information. Okay. Yes. So the evidence supports the semi strong form because, as we can see, the price increased. Okay. All right. Part B, using the financial ratios provided, analyze the performance, profitability, and the financial risk leverage of FZB in 2023 compared to 2022 and the industry average. Based on your analysis, explain whether FZB's fundamentals justify the increase in its share price. Okay, so now we come to the financial statement, the actual financial statement here, right? This is where I'm going to explain what each ratio is, okay? We're going to start with the return on equity. Okay, let me just do this here. Let me get the table here. So first things first, we're going to define what profitability is. Profitability is just how a company generates profits from its operations. That's what profitability is. Generating profits from your operations or how well you make profit. Okay? That's one way you can take profitability. Right? Then leverage, okay, is how much debt a company, or in this case the bank, relies on. How much debt does this bank rely on? Okay. Now, on a bank's perspective, they'll rely on a lot of debt because they're getting your money and loaning out to people, so it's part of their business. Okay. But for the normal companies, right, the more debt the company takes, the more interest payments it needs to pay out. Now, the risk that you might not pay those interest payments is what you call financial risk. So even this bank, it's taking on debt. Now, the more debt it takes on, the financial risk starts to increase. Okay, just remember, if you are a business, let's say, as we start on a small scale, if you are an entrepreneur, you would rather fund your business with your own money versus borrowed money. Okay, because when you are using borrowed money to fund your business, what if you make a loss and you fail to pay the interest? That's the financial risk. Now, on a bigger scale, we take it to companies. Okay, so we're going to start with the profitability analysis. Okay, yes. So we're going to start with the return on equity. How much profit a company earns for each 1 kwacha or 100 kwacha of the shareholders' money which has been invested. Okay, the shareholders' money has been invested. How much profit are you getting from that? That's what the return on equity is saying. Okay, invest the shareholders' money. How much profit should we get? A higher return on equity means we're getting more profit from the shareholders' money, which is a good thing. Okay, because when you sell shares, you're going to raise money. That money you're going to invest it for operations. Okay, so when you invest that money, you expect to earn some profit. This is what this return on equity is. Okay, so this is the formula for the return on equity. Okay, profit after tax over the shareholders' equity. All right. So I want us first to understand something about this ratio here, this formula here, so that whenever you do ratio analysis, you'll be okay. This formula here, return on equity equals profit after tax over shareholders' equity. Right? The return on equity and the profit after tax, they have a positive relationship. Okay? If shareholders' equity is held constant, meaning if there's no change, or if the change is little, if the profit after tax increases, your return on equity is going to increase. At the same time, the return on equity has got a negative relationship with the shareholders' equity. Okay, if you hold the profit constant, all right, meaning the profit doesn't change. Okay, if you increase the shareholders' equity, you'll find return on equity is going to go down. Okay, so for a company or any business, all right, if you are increasing this shareholders' equity, okay, if you increase this shareholders' equity, what you must hope for is that this profit also increases so that your return on equity also increases eventually. Because if you increase the shareholders' equity and the profit doesn't increase, let's say it even drops, it means your return on equity is also going to drop. So basically, what I'm saying in simple terms, if you invest more of the shareholders' money, you have to make more profit. Because if you're investing more of the shareholders' money and your profit is not increasing, then it means like you're wasting the shareholders' money. Whatever you have invested in is not really bringing you any profit. Okay. So, how we interpret this? In 2023, FZB's return on equity is 22%, meaning if 100 kwacha of the shareholders' money was invested, okay, 22% of 100 kwacha is 22 kwacha. Then 22 kwacha came back as profit. Okay. If a 1,000 of the shareholders' money was invested, then 220 kwacha is the return on the equity or the return from the money invested. Okay. Yes. Then in 2022, it was 18%. So, meaning in 2022, for every 100 kwacha of the shareholders' money, FZB was making 18 kwacha. Okay. So, colleagues, we've seen FZB in terms of the return on equity, they are doing better. They're earning more from the shareholders' money. Okay, from 18 kwacha, excuse me, from 18 kwacha to 22 kwacha. Okay, so this can be one reason. This can be one reason to justify the increase in the share price. Okay, because the return on equity has grown. Any questions, colleagues? So as you can see here, oops. Yes, colleague, sorry about that. Was kicked out. Mm, yes. Any questions on return on equity? Any questions? It's just telling you how much profit you're getting from the money, the shareholders' money that has been invested. Okay, how much profit you are earning for the from the shareholders' money that has been invested. That's what it tells you. Okay, so for FZB, it increased from 18 kwacha to 22 kwacha. So this, as the question is asking here, okay, let's see where is that. Where they say explain whether FZB's fundamentals justify the increase in its share price. Yes, this can be a justification of the increase in the share price. Okay, they're doing they're doing well. Okay. The next ratio is earnings per share. Okay, so earnings per share basically, what it's that's telling you is that profit, this profit after tax, if it's distributed to all the shareholders, how much will each shareholder get? That is earnings per share. Okay, how much you get for holding each share. Okay, that's what earnings per share is. This is the formula here. Okay, profit after tax minus preference dividends. Preference dividends, because these go to the preference shareholders, and we're only focusing on ordinary shareholders. So the preference dividends would deduct them out. But basically, as you can see, profit after tax divided by number of ordinary shares. So basically, how much is from the profit that has been distributed to all the shareholders, how much is each shareholder getting? Okay, so it increased. In 2023, it's 4 kwacha 50 ngwe, 2022, 3 kwacha 60. So it means there has been an increase, meaning each shareholder is getting more. Okay. Although in reality, a company cannot pay out all its profit after tax to shareholders, it has to keep some of that money. Okay. But we're just saying in a situation where it had to share that profit to the shareholders, how much would each, for only one share, how much is each shareholder going to get? Okay. So it's increased by 90 ingwe. So, yes, colleagues, this can also be a justification for an increase in the share price because if you're earning more per share, then it's only logical to increase the share price. Okay. Yes. Any questions on earnings per share? Okay. Oh, and this increased by 25%. Earnings per share increased by 25%. Okay. So as you can see here, a higher earnings per share means the bank earned more profit for each share. This is usually good news for investors because it often supports higher dividends, higher share prices, better investor confidence. Okay? Yes, so that's another justification for the share price. The earnings per share for this company has grown. Okay? Yes. Then dividend per share, how much dividend are you getting for owning one share? Or how much dividend is each shareholder getting? That's what dividend per share is. Okay. Yes. So we can also see here it increased. In 2022, 1 kwacha 16 gwe. In 2023, 2 kwacha. So the shareholders are earning more dividends in 2023. The dividends have increased. They've increased by 40 ngwe. okay, which represents also a 25% increment. Okay, remember how I'm getting these increments is just the new value minus the old value divided by the old value times 100%. Okay, so here it's just the same as 2 minus 1.6 divided by 1.6. So the dividends per share has increased by 25%. So the shareholders are making more dividends. Okay. So since FZB showed these results, they reduced this public information. Investors saw that okay, the earnings per share has increased, the dividends per share has increased also, return on equity has increased. Okay, these ratios they directly relate to shareholders because they deal with shares and shareholders' equity. So, to you as a shareholder, if you see an increase in this, it's going to influence you to want to buy shares in the company. Okay. Yes. Any questions before? Let's see. Oh, price to earnings ratio. Now we don't have for FZB in 2023. But this price to earnings ratio, what it tells us is just telling us how much people are willing to pay to earn one quarter of earnings in FZB. Okay, how much people are willing to pay for the shares just to earn a one quarter. So if you say a price to earnings ratio of 5.5 quarter, it means investors are willing to pay 5 quarter 15 way for the shares so that they can earn a one quarter from those shares. I hope we're together, colleagues. How much you're paying to buy that share so that you can earn a one quarter from that share. This is price to earnings ratio. Okay. A higher price to earnings ratio means that company is doing well. There's investor confidence. That's why people are willing to pay more just to earn a one quarter from that company. Right. But a lower price to earnings ratio, okay, it may not it may not signal high investor confidence. Okay. Yes. But usually, this price to earnings ratio, the higher it is, it gives you an insight about the company. Okay, the higher this becomes, the more then you can get an insight that okay, this company is doing. There's investor confidence. People really want to invest. Obviously, this company is making profits. They're doing things well. That's why people are willing to pay high amounts just to earn a one quarter from their shares in terms of dividends. Okay, colleagues. So here, um, we only have the industry average. Industry average, this Lusaka Security Exchange All Share Index. This All Share Index, colleagues, is just one single number that is representing the companies, all the companies, or majority of the companies in the Lusaka Securities Exchange. Okay. If you want to track how Lusaka Securities Exchange is doing, since there are many companies there, so you can't have a lot of figures to represent how it's doing. You need an index. Okay. When you hear this word index, it's one number representing a lot of things, or a lot. In this case, one number representing a lot of companies. It gives you an overall picture of how the Lusaka Securities Exchange is doing. Okay. So in terms of profitability, this company FZB is doing well. Yes, their return on equity has increased, and you can see in 2023 it's even greater than the industry average. Okay, in the industry average, for every 100 kwacha of the shareholders' money, the companies are earning 19 kwacha. But FZB, for every 100 kwacha of the shareholders' money, they're earning 22 kwacha. So you can see that they're doing better than the industry. Price to earnings, the industry is doing better. Okay. People are willing to pay more for shares on the Lusaka Securities Exchange to earn a 1 kwacha from those shares. The people are willing to pay 6 kwacha for, on average, for companies within the Lusaka Securities Exchange. Investors are willing to pay 6 kwacha for those shares so that they can earn a 1 kwacha in terms of dividends. That is price to earnings. Then we can now go to leverage. All right. How much debt is being used? Okay. So this debt to equity ratio, it's just comparing how much debt you have compared to equity. Or in simple words, are you using more equity financing, your own money, or are you using more debt financing, borrowed money? Yes. You just get the, you're talking about this one here, the earnings per share. And it's, you, if you don't have preference different dividends, you just divide the profit after tax divided by the number of ordinary shares. The reason why you're removing preference dividends because preference shareholders and ordinary shareholders are in different classes. Okay, preference shareholders, these are the ones who are entitled to fixed dividend, but they can't vote. Ordinary shareholders, the dividend is not fixed. Some years you might get paid, other years you might not get paid, but your dividends can grow. So, madam, if you're not given preference dividends, just divide profit after tax by number of ordinary shares. You're given preference dividends, deduct it from the profit after tax, so that that remaining profit is the one that you're evaluating if it's distributed to the ordinary shareholders. Okay. Yeah, here is also the formula for price to earnings ratio. Okay. How much investors are willing to pay for 1 kwacha of earnings? How much are willing to pay for 1 kwacha of earnings? Yes. So the debt to equity ratio, as I said, um, you're just comparing how much debt you have for every 1 kwacha of equity. For every 1 kwacha of your own money, how much debt do you have? So let's look at FZB. In 2022, it was 7, meaning for every 1 kwacha of equity FZB had, they had 7 kwacha in debt. Okay. For every 1 kwacha equity, they have 7 kwacha in debt. Okay. So they are using more debt than their own money. So there's a financial risk. Although this is a bank, so usually with banks, should they ever fail to pay you, the central bank will come in to try and help out. But if it's with companies, there you have to be very worried. Okay. Then in 2023, for every 1 kwacha FZB had in equity or their own money, they have six kwacha 15 go in debt. Okay. So we can say their financial risk has dropped by a small amount. Okay. By 15 way. Okay. Which may not be that significant, but FZB is trying to communicate to you that We are trying to work on our financial risk or trying to reduce it. Okay. The industry average for every one kwacha of equity companies have on the Lusaka Securities Exchange, they have 6 kwacha, 8 ngwe in the debt. Okay. So here we can say FZB has done better than the industry and than the previous year in 2022. Because as an investor, colleagues, you want to invest where people are using their own money. If someone is using more debt, as we've said, if they don't make a profit, they will fail to pay those interest payments. And we know what happens when companies fail to pay debts. It is not a good thing. Okay. So, yes. In terms of leverage, it has dropped by a bit by 15 where the debt to equity ratio. Okay. So we can say that is it's not that significant. Okay. Yes, it's not that significant. Okay. Yes. Any questions? Okay. So FZB increased its total dividend from 1 kwacha 16 ngwe to 2 kwacha per share. According to the signaling hypothesis, a key part of the relevant hypothesis of dividend policy, why might FZB's management have chosen to increase the dividend? So, colleagues, this signaling hypothesis, as it says, yeah, the company is trying to send a signal to the investors that this is what is happening, so invest in us. Okay. The company and its management are trying to send a message to the outside world that come and invest in us. So, one way you can send that message through the signaling hypothesis is if you increase the dividends. Because if a company increases the dividends, the message that reaches the investors out there is that if you invest in this company, you're going to get more dividends. Okay. So why they have chosen to increase the dividends so that it sends a message to investors that if they invest in FZB, they are going to gain more dividends. And by telling investors that, people are going to want to buy shares in FZB. And remember, when demand for your shares increases, also your share price increases. Okay, so this signaling hypothesis is, I've also sent notes on it. Okay, the notes are simplified. Okay, I'll expect everyone to read through those notes. Okay, so that you understand what's going on here. Okay. Yes. Then, how does the market's reaction to the dividend announcement and the overall results relate to the concept of information asymmetry? Okay, so colleagues, there are two important terms you need to know about. There's information asymmetry and there's information symmetry. Okay. Information symmetry is where all parties know the information. Information asymmetry is only one party knows the information. Basically, this is management. They have some information that only is internally known by management. Okay, it's only known by management. The outside world doesn't know. Uh, So this is how you will write your answer. The market reaction shows how information asymmetry is reduced when management releases credible information. So when management now releases that information, it changes from asymmetrical to symmetrical. Before FZB published these results, it was their management who knew about it because they had their financial reports. They did their calculations, they did their financial ratios. So they were aware of that information. That is information asymmetry. Before FZB published its results, it's only management who knew how they performed. But after they released their results, where they're telling you their profit after tax has increased, return on equity has increased, earnings per share has increased. Once they release that information, it becomes symmetrical. Okay. So before the announcement, managers knew more than the investors about FZB's actual 2023 performance and future outlook. This difference in information is called information asymmetry. Okay. Only management knew. Investors were uncertain about the bank's true financial strength. But then, when FZB released the audited results, showed higher profits, lower loan loss provisions, and higher dividend, now the public got aware. The public disclosure reduced the information gap between insiders and investors. Okay, and then investors then updated their valuation of the bank and the share price rose. So after the information has been released, investors have seen, okay, this company is doing well. They start investing and the share price rose. Okay. Yes. Any questions, colleagues?